This is the economic and market report for the week ending September 30th, 2022, and beginning a look ahead at the week of September 3rd, 2022. So I've changed the format of this a little bit. I'm not doing my personal sentiment anymore. Uh, Getting quite a few views, but have also people leaving very early. So if you are one of those people that's leaving early, if you'd leave a comment, that would certainly help me, and I would appreciate it. The biggest news of the week was the UK doing quantitative easing while raising rates. I mean, it's not any different really than what the U.S. is doing by raising rates and continuing to spend lots of money coming out of the government. We need less government and less spending. I mean, both actions are just, it's ridiculous. And, this isn't just a Democrat thing either. This is a Republican thing. You can't do tax reductions unless you're going to cut government, first. So just doing tax reduction doesn't help anybody or the economy. So, I think what happened in the UK gave investors and traders some hope in the fact that the UK folded by doing quantitative easing, and so American investors were kind of looking at that and probably going, "Yeah, I don't know how long the Fed's going to last." Who knows? I just want to look at some of the economic indicators. I'll save commentary for different videos on things like that. So let's start in. One of the things that I'm adding, or will be adding, is also the Fear and Greed Index. But let's start with the AAII Investor Sentiment Survey. And as you can tell, the bearishness is still very high within the market at 60.8%. And these are historic numbers, as I mentioned last week. The 60.8% is as high as it's been ever, other than a reading of 70% at one point. But it doesn't necessarily indicate where the markets are going to go on that. So, I think at the 70% and at the previous 60% reading, one went north, one went south. So, who knows what's going to happen with regards to that. Now, my tendency personally is to be the contrarian to this, but if you're in the Great Depression, everybody's going to be bearish too. So, that's something to consider. The Fear and Greed Index that CNN puts out, extreme fear. Only one of the indicators in here was just fear, which was stock price strength. And, that may be on its way too, because we closed Friday well down late in the day, actually. So the Fear and Greed Index right now, there's a lot of fear in the market. There's a lot of money sitting on the sideline, and for some people that play it that way from a contrarian standpoint, and may see it as a good time to enter. But there's still so many unknowns, and we'll go through some of those as we move forward. Now, one of those unknowns, let me start with the knowns. The known is that the federal funds rate is at 3.25%, and we have an expectation that the Fed is going to be raising probably 4 days before the election, which I thought might give pause, but a tanking market is not necessarily good news for the party in power, but we'll see what happens at that time. If we also look at the 10-year Treasury that I use as a key indicator, it's at just short of 3.75%. Now, this is much higher than what I expected to get. And for the week, it was relatively flat. It was up a little bit, 3.73% to 3.822%. So we're, these are numbers that are very high. It's starting to obviously affect, borrowing. It affects mortgage rates. This 10-year Treasury, to me, is a good indicator of kind of the health of the economy. And, my expectation is still that, it will roll over. But, who knows? I don't know how long the Fed continues to raise rates. So this is one of those things to watch because it affects everything really in the economy. It's just a real good basic indicator for economic activity. If we go to the, that's the SPY. Let's go back to the DXY, something I've talked about in almost all of my reports, is that the DXY, that's the daily or the weekly. Let's take a look at the daily. It's looked like it was starting to reverse. It kind of stabilized today. Nothing goes down in a straight line, and that doesn't mean. We've had a few of these fake outs, a number of them where the expectation was back in June and was that was going down and went back up. The strength of the dollar, and then same here during this time period. Move this out of the way. In July, again in September, and then here in late September. So the DXY, the more it goes up, the more problems that are going to be caused. And as I mentioned in each one, you might want to watch the video. I'll put it up here on the Milkshake Theory that Brent Johnson put together. There's kind of this battle going on between Brent Johnson and Peter Schiff over what's going to happen with the dollar. Peter Schiff is expecting it to go down. Brent Johnson, his whole theory is based in the rise of the DXY, and that's why you're starting to see problems like you had in Sri Lanka and now the UK. A strong dollar affects other countries as it sucks the liquidity out of their economies. And because we have higher interest rates here now, people are putting their capital into the U.S., taking away from their own countries. So this is causing problems. And I've read several articles about how some of the other central banks are certainly complaining to the Fed about their continuing to raise rates. And it doesn't mean the economy in the U.S. is good. It just means that everybody else's is horrible. And they've spent as much money as the U.S. So, this go up or down. If it starts to go down, you might see a little relief, in the markets. If it continues to rise, I think it's going to cause more problems. And this will be one of the factors that the Fed will potentially reverse their course. So that's the DXY. One piece of good news is that the WTI Crude continues to, under $80, starting this week. And, that means that we're going to be paying less at the pump. Now we just had a hurricane. So what does that mean? So we've got a lot of things, one good thing, one bad thing. So, my expectation is that this will continue to go down as the economic conditions continue to deteriorate here in the U.S. Durable goods orders, not good news, down 0.2%, although they were expecting negative 0.4% this week. So better than expected might be the way to look at it. New home sales, surprisingly, were up. But if you go back to the beginning of the month, you'll realize that mortgage rates at the beginning of the month were a little bit lower. And my thinking here is that this will start to revert back down as soon as the 7% interest rates start to hit the market. So we'll keep an eye on that. And the United States personal spending, the consumer continues to stand up. Expectation was 0.2%. Previously, it was reported at negative 0.2, and now the actual was 0.4. So still hanging in there. I guess we still have room left on the credit cards. Chicago PMI came out, and actually the manufacturing activity wasn't as bad as what I thought we might begin to see, but the Chicago PMI came out today, and it was down considerably. That's a pretty big move, 6.5 points down, from the previous report, and so we're starting to see slowdown in some areas. Some things are holding up. We'll see. Another kind of surprise to me was the Michigan consumer sentiment that came out today. The expectation was it would be 59.5, so it came in below expectations, but came out better than the previous month. And so, like I said, the consumer's hanging in there, but is it because of credit cards? I mean, let's see. Debt, credit card, we can see it's moving up, and there's quite a bit of debt out there, in $16 trillion in the U.S. So the credit cards are starting to go up. The consumption expenditures. This is the PCE price index, and this is something the Fed does keep its eye on. And as you can tell, it moved back up surprisingly, and this is another factor that will play into the Fed, since this is one of the things that they keep their eyes on. Is previously it was negative 0.1%. And now it's 0.3, so we can't be bragging that inflation's going away yet. And again, this is one of the factors that the Fed uses. So will they continue to raise rates even, with what's going on, and the fact that the UK folded like a cheap suit or a house of cards or whatever you want to, what idiom you want to use. Let's take a look at the economic calendar for the next week. We have the ISM manufacturing PMI. That's an important one that'll come out. Give an eye on economic activity. We got the JOLTS job opening report. We've got the ADP employment change, which is a precursor, but it seems to have been disconnected from a lot of the employment data that we see, the unemployment rate and jobs added and things of that sort, which is kind of interesting. Non-manufacturing PMI, the unemployment rate will come out on Friday, October 7th. That obviously will be watched by the Fed. And if we don't start to see this number go over, then you add that with the PCE, you can almost plan on that the Fed will stay the course, moving forward. And, non-farm payrolls, all those things are going to play a factor. So it's kind of an important week upcoming as far as economic measures go. So to keep this shorter, I'm attempting to cut that off here. And like I said, I think what I'm going to do is put together a video on my personal sentiment, some of the things that I'm doing, what my expectations are moving forward, and hopefully that will help people, or at least make you think about some of these things that are happening now. So that's what I wanted to cover this week as far as economic indicators. And remember, there is always a better way.